All right, let's move to the latest from the US. The latest US GDP data shows a second straight contraction in the US economy. And according to data by the Bureau of Economic Analysis in the US, the economy contracted 0.9% in the second quarter. The first quarter GDP fell, remember, by 1.6%. And what that means is that the US economy has now witnessed a technical recession. The definition states that consecutive quarters of contraction is in fact a recession. Now, remember, overnight you had the Fed that raised the policy rates by 75 basis points in its fight against inflation. On the jobs front, and this is a separate piece of data that has come in, the weekly jobless claims came in at 256,000 last week, above street expectations, and the US 10-year Treasury yield has fallen now. It fell in trade today as well. Let's put all of this in context, and in fact, let's speak to Peter Cardillo, who's joining in right now. Thanks so much, Peter, for taking the time. Help us understand where we stand right now, because all of this, we've been building up, I think, to this point for a little while right now. The Fed has gone ahead and raised rates again, as expected. It is guided that it might just do that in the future. It seems to be more concerned about inflation than it is about slowing growth. How does the market see it?
Well, I think, the markets are looking at it from a recession perspective that the markets have already discounted this. If you look at the performance, stocks are basically up a little bit, but what's catching my eye right now is the transportations, which is up rather sharply. So basically, the contraction tells us from a textbook viewpoint that we are in a mild recession. But this is no new news to the market, especially to the bond market. The bond market has been flashing this now for a long time. We've had an inverted yield curve, and generally, when you have that, obviously recession is behind the door. This time, it's not behind the door, but it's become a reality. Now, I do admit that it's some sort of a peculiar type of a recession because we have a very strong labor market. And of course, that was pointed out yesterday by the Fed chief. But nevertheless, if you look at most of the components of the GDP, we saw that there was a drag on inventories and corporate America pulling back on spending. This is a perfect atmosphere of a recession. However, the good news is that the core PCE from last quarter actually fell rather sharply at 4.5%, as opposed to nearly 5.5%. So this probably means that the Fed is going to raise one more time and then probably a pause, and probably in the second half of 2023 we could probably be looking at a rate cut, because by that time inflation will have been evaporated, and the economy will need some crutches.
Peter, the other point that I really want you to get your perspective on is the fact that individual borrowers, mortgage borrowers in the US are perhaps not used to the kind of rates that you're currently seeing. Do you anticipate that lenders will be able to absorb any potential delinquencies? Do you see that as an area of concern going forward? And is that something that will spread?
No, that is a concern, but I think that look, the Fed made it very, very clear they want to get to normality, 3, maybe 3.5%. Well, we're not that far away, and so for now, I don't think that's a problem. But if the economy cools too much, and if the recession should turn into a steep recession, then it's going to be a problem. But for now, I think they can handle it, because look, as I said before, this is a peculiar type of a slowdown, and it was mostly due to the Fed reversing the zero negative interest rate policy, getting back to normality. And so that's why we saw that big drag in inventories and, of course, a big drop in corporate spending.
Peter, thanks so much for joining in for that perspective. I'm sure we'll keep speaking to you in the coming weeks to get more.